Why should I keep a portion of bonds in my portfolio when these returns are pretty abysmal and sometimes even negative?
Yeah. Okay, so this is a philosophical differential that I run into constantly with the way that I handle portfolios versus the way that other people tend to think about them. I don't look at bonds as an investment per se. I look at stocks as an investment. Wealth is created from real estate and stocks for most of us, unless you're a superstar like LeBron James who creates wealth by playing basketball or whatever. For the majority of us, we create wealth from stocks and real estate. So I want to have each client have as much stock as they can possibly handle, right? In terms of their own tolerance to risk. That might be 10% of the portfolio stock. It might be 100%, whatever that might be. And so then what the bonds make up in that portfolio is the parachute for when the stock market falls apart. Because literally, you're right. The bond market for the last year is actually down some. But I'd rather be, if the stock market drops 35% and your bonds are down, zero point 0.1, bonds look awesome in that environment. And so what it does is it just allows you to have kind of a parachute. And it's a great analogy altogether. You got to have the right size parachute, right? So if you're going to jump out of a plane and your parachute is this little teeny thing, you're going to fall hard, right? And so you have to understand what that is. Bonds can sometimes go up when stock market goes down. That's what we saw in this last downturn. Not always, but generally they do fall less when they do fall. Like 2008, the S&P 500 was down 57%, something in that range. I'd say the average bond thing that we were looking at was down maybe 8 or 10, still pretty dramatic, but that's a heck of a lot less. Bonds look fantastic in that environment. And so it's the parachute. Bonds are a parachute. Now, you can do some things to try to moderate. I think right now our average return on bonds is positive, just barely, even though the stock market is negative. And so we've done some things with Treasury inflation protection securities. We've done some things by having some short-term bonds instead of so many long-term bonds. But you have to be really careful there. If you do everything kind of really short-term bonds, you just made a teeny little parachute because they don't go up much when the market goes down. And so, again, all of a sudden you're falling out of that plane with I used to have these little GI Joe guys that had a parachute. That's my visual. So you don't want to have the GI Joe parachute really, because when you're a lot heavier than that plastic GI Joe. So basically, you want to make sure that that parachute is adequate for the risk that you're willing to take. That's what bonds are. And even if they underperform, the stock market's up 25% this year. I don't care if the bond market's down 1%. It doesn't matter to me whatsoever. Thus, we make our money on the stock side. What I'm worried about is the negative 25% in the stock market that could happen. I want to make sure that, those bonds are there to mitigate some of that risk. And that's what bonds are for. And that's a different outlook. People look at bonds as rate of return vehicles. They're looking at yield all the time. They're chasing yield. So right now, if you're chasing yield, you've probably got a lot of high yield bonds. Those drop. I think the stock market was down 35% in 2020. High yield bonds that I was looking at dropped about 23%. That's not a parachute at all. It has a high yield. And we have some high yields in there because it's part of the mixture, but most of our bond mixture is around the parachute, trying to have a good amount of treasuries, even though treasuries aren't that great and probably won't be that great going forward. But you never know when we're going to face the next 35% stock market drop, and so that's what they are. And again, not everybody agrees with that. Believe me, I've run into different scenarios, but that's what I've been doing for 35 years, and I stand by that wholeheartedly. Because if you do the bond portion right, it allows people to stay in the stock market. It allows people to have a higher percentage of stocks in their portfolio. And that's where the money is made, stocks and real estate. Those are the two things that we all get wealthy off of, not bonds. I've never met anybody that got wealthy off of bonds outside of the bond brokers like Michael Milken and what have you.